Many federal employees who leave government service before qualifying for an immediate retirement often worry about how they will replace their FEHB health insurance when their job comes to an end. One of the primary options available to federal employees and their families to help bridge the loss of federal health benefits is temporary continuation of coverage, which is also known as TCC. This program allows you to temporarily continue your FEHB health insurance after your regular coverage ends. In this video, we're going to discuss the ins and outs of TCC and break down how it works and what it costs. But before we dive into the details, welcome to the Money Briefing. My name is Jarrell Harvey and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. Losing federal health insurance can feel stressful, especially if you or a family member has a pre-existing condition. A gap in coverage may cause you to lose prescription benefits, miss doctor's appointments, or pay out of pocket for serious medical care. With TCC, you can keep all the health benefits you're accustomed to, but there are some important factors to consider. Unlike regular FEHB coverage, TCC is not a long-term or permanent solution. Instead, it helps you keep your health benefits for a limited time when you're between jobs or facing other transitional periods. TCC works a lot like COBRA coverage in the private sector, but it's not exactly the same. Generally, there are three groups that are eligible to have their own TCC coverage after a qualifying event. Those three groups are employees, children, and former spouses. Employees are usually eligible to start TCC after they resign or after they are laid off. As a federal employee, you may qualify for TCC whether your separation is voluntary or involuntary, as long as it's not due to misconduct or after 12 months of being on leave without pay. Employees can continue TCC for up to 18 months after they separate. Participants that fall into the category of children usually become eligible for TCC once they turn age 26 and can no longer qualify as dependents on an employee's or retiree's health plan. Children can also get TCC if an employee or retiree passes away and the child does not qualify for a survivor annuity. Stepchildren and foster children may also qualify if they are covered under your health plan. Children can continue TCC for up to 36 months after a qualifying event. The last group of former spouses become eligible for TCC after a divorce or annulment. Ex-spouses can enroll if they were covered as a family member at any time in the 18 months before the marriage ended. To be eligible for TCC, previous spouses cannot qualify for FEHB coverage through any spouse equity provisions and must not remarry before age 55. Similar to children, former spouses can continue TCC for up to 36 months. Outside of the length of coverage terms, many of the benefits associated with TCC for employees, children, and former spouses are similar. So for the remainder of this video, I'm going to mostly focus on how TCC works for federal employees. After leaving federal service, your regular FEHB coverage will continue until the end of the pay period when you leave. Then you get a 31-day extension of coverage at no cost before your TCC coverage begins. With TCC, you are not limited to any specific plan or coverage type. You can choose self-only, self+1, or self and family coverage. You can decrease your enrollment from self+1 or self and family down to self-only at any time. You also have the option to switch plans if you need something different or more affordable. However, you usually can only change your health plan benefits before your initial enrollment date, during the annual open season, or after a qualifying life event. As I previously mentioned, after your regular FEHB coverage ends, you get a 31-day extension of coverage at no cost. But it's important to note that the 18-month period for TCC starts right after your regular FEHB coverage stops, and it includes the 31-day extension of coverage. If you choose to change plans or coverages when selecting TCC, your enrollment in the previous plan will continue through the 31-day extension. Then, your new plan and premium payments start the day after the 31-day extension, and it can last up to 17 months. After your TCC coverage ends, you get another 31-day extension at no cost, unless you cancel your coverage early. Since there are a lot of dates and numbers to keep track of, here's an example. Let's say John separates from service on September 30th, 2025. His regular FEHB coverage will continue until the end of the pay period, which is October 4th, 2025. Then his free 31-day extension of coverage will run from October 5th to November 4th. If John decides to switch to a different health plan, his enrollment with the previous plan will stay active through the 31-day extension. His TCC coverage with the new plan will begin on November 5th, 2025. The temporary continuation of coverage period ends on April 4th, 2027, which is 18 months after his regular FEHB coverage ended. Finally, John gets a second 31-day extension of coverage that ends on May 5th, 2027. I also want to point out that the beginning and ending dates of TCC enrollments are not always the same as the beginning and ending date of a pay period. When this occurs, your premium charge will get prorated. Also, if you elect TCC after the 31-day extension, you will be billed for premiums retroactive to the effective date of coverage, which leads us to another huge factor that you must consider with TCC, and that's cost. When you're working as a federal employee, the government covers about 70 to 75% of the FEHB premium costs. However, there's no government contribution towards the premiums charged for TCC coverage. So, in other words, when you pick TCC, you take on the full cost of your health insurance. You're responsible for paying the government's portion and the employee's portion. On top of the premium cost, there is an extra 2% administrative fee that gets added to the total monthly cost. Therefore, you basically go from paying about 30% of the cost to paying 102% of the cost when you go from regular FEHB to TCC. This amount is paid on a monthly basis rather than a bi-weekly basis. As an example, this chart shows the regular bi-weekly and monthly costs for the different Blue Cross Blue Shield basic plans because that's one of the popular options under FEHB. The Self Plus One plan costs about $274 on a bi-weekly basis, which equals around $594 per month. Under TCC, you will pay $2,042 for the same coverage, which is an increase of nearly $1,450 every single month. If you want to check the TCC cost of your individual health plan, I've added a link to access the TCC cost in the description notes of this show. Also, from a tax planning standpoint, premiums for TCC are paid with after-tax dollars, so you don't get the tax advantages like you do when you're working. Your agency is responsible for providing you with information about your right to TCC. However, many agencies contract with the National Finance Center to administer TCC enrollments and to help process payments. It's also really important to keep in mind certain deadlines for enrollment. You must submit a TCC election to your agency or employment office within 60 days after you separate from service, or it can be 65 days after the date of your agency's notice regarding TCC. Whichever date is later between the two is the final deadline. When enrolling in the TCC program, you must complete the necessary forms and submit them along with any required documentation. In addition to TCC, you may want to consider other health insurance options. Marketplace plans are one potential alternative. A major advantage of marketplace plans is the potential for government subsidies and tax credits. These credits are based on your income and can significantly reduce your monthly premium costs and your out-of-pocket costs, especially if you're on a limited or fixed income. There's also short-term health insurance plans that you can get from private carriers that can usually last between 1 month and 1 year. Short-term plans vary a lot in their covered services, but these plans are generally limited and may not cover pre-existing medical conditions. Another option is a spouse plan if you're married. If your spouse has health insurance through their employer, losing your FEHB coverage is a qualifying life event that allows your spouse to add you to their plan. You usually have 30 to 60 days to enroll in their plan through a special enrollment period. Lastly, if you get re-employed, you may consider your new company-based health insurance plan. You can cancel your TCC plan at any time. So overall, temporary continuation of coverage helps keep you and your family covered during big changes. But the limited duration and high cost could make other options a better choice. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com, or you can click on the meeting link in this video's description. Thank you for watching, and we'll see you on the next Money Briefing.